Hello, everyone. Thanks for tuning in today. We wanted to provide you with a brief update on what we're seeing on the market. And later on in our conversation, we will discuss some tactical changes that we are making to our portfolios. So, for those of you that have been following along with what the stock market is doing this year, we've seen some names that have had great years in 2025 and 2024 have been in a pretty steep drawdown as we've approached 2026. So a lot of the names that have been high flyers or generating high revenue have taken a hit due to potential AI disruptions. So companies that many believe, or that certain investors believe, AI can come in, they can replicate what they're doing, and potentially cause a sharp decline in their revenue. However, on the flip side of that, we have seen the Dow reach a new all-time high, and we have seen companies that have historically been viewed as value plays hit new record highs. So these are companies that hold large assets and are that are not susceptible to potential AI disruption. So companies that many believe cannot be disrupted by AI. So we've seen oil companies, we've seen companies like Coca-Cola and Pepsi, companies like Procter and Gamble hit new record highs or new 52-week highs due to money flowing out of tech and into these value names. So what we wanted to do today is bring on our portfolio manager, John McKay, and he's going to discuss some of the tactical shifts that we're making within our portfolio.
Thanks, John. Yeah, we still like AI, but we see those multiples climbing higher and higher. And the market's kind of shifted in a risk-off perspective. They're getting a little bit more hesitant when it comes to earnings calls. You might beat earnings, but revenue's down, or a specific division's revenue isn't where you want to see it. And, looking at Microsoft, great earnings, but their cloud revenue wasn't where people wanted it, and it tanked.
Yes. Yep.
So looking at that, kind of strategically moving away from the level of large cap growth exposure that we have, moving into some buffered ETF positions to protect downside gives us a little bit of dry powder. When we see those multiples get to a place we want, we're able to shift back into some of that exposure. Additionally, moving into equal weighted S&P 500 exposure versus value weighted, where we see immense concentration in the Mag 7. Again, it's not that we don't like those companies at the top, but we just see multiples at a place that we don't think they're going to stay there long term. We want to see those compress a little bit, and then we have the ability to move that exposure back on. Additionally, in the fixed income market, from 2022 to 2024, we saw a deeply inverted yield curve. So you weren't getting upside for having longer duration on your exposure.
Right.
That started to shift back, and with Kevin Warsh, assuming that he gets approved through the Senate, we should see a steepening yield curve. And with that, we've kind of moved our exposure further out on the yield curve, expecting to get better returns having that longer duration.
Yep. Yeah, that sounds great. So, like John had mentioned, these are some of the shifts that we're making for this quarter ahead. And as we're evaluating the market to see what's going on, like John had mentioned, we're not shying away from some of the Magnificent Seven stocks, but we are seeing a broadening of returns and economic growth, hopefully leading to more companies will continue to perform better. Also on the fixed income side, extending some of that duration. So not only having a short-term bond position, but adding some of that intermediate-term bond exposure as well to our portfolios. So there's the update. Thank you all for following along. If you have any comments, feel free to leave those below.